Welcome to StockTok's deep dive into the Toronto Dominion Bank. TD is one of North America's largest financial institutions, operating as a diversified banking and wealth management powerhouse across the United States and Canada. The company generates revenue through retail banking, commercial lending, investment services, and wealth management, serving millions of customers and managing hundreds of billions in assets. As of May 11th, the stock is trading at $107.95. Over the past 52 weeks, the stock has ranged from $63.11 to $109.22, positioning the current price near the upper half of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. The Toronto Dominion Bank operates across retail and commercial banking, capturing net interest margin, the spread between what the bank pays depositors and what it charges borrowers. The company also earns fees from wealth management, investment advisory services, and trading operations. TD's competitive positioning rests on its scale, its established deposit base across 2 countries, and its integrated banking and wealth management platform. The thesis around banking stocks generally hinges on interest rate stability, credit quality of the loan book, and the company's ability to manage deposit costs. With that framework in mind, here is the StockTok score: 30 out of 100 rated avoid. Valuation scores 4 out of 20. Financial health scores 7 out of 20. Profitability scores 6 out of 20. Growth scores 11 out of 20. And smart money scores 2 out of 20. The picture is decidedly cautious across nearly every dimension. Now, valuation. The question every investor has to answer: are you paying the right price? The Toronto Dominion Bank is trading at a price-to-earnings multiple of 12.01 times trailing 12 months earnings. For context, that is below the historical average for large-cap banks, which suggests the stock is not expensive on a pure earnings basis. The forward price-to-earnings multiple, based on the next 12 months of expected earnings, sits at 15.29 times. The PEG ratio, which compares the price-to-earnings multiple to expected earnings growth and helps identify whether valuation is stretched relative to growth, is 2.71. That figure warrants scrutiny. A PEG above 2 can signal that growth does not justify the premium valuation, though in banking this metric is less reliable than in technology or consumer stocks. The price-to-sales ratio is 3.97 times. On an enterprise value to EBITDA basis, the multiple is unavailable due to the nature of banking accounting. The most important signal comes from our discounted cash flow analysis. Our DCF model suggests the stock is trading at a 24.38% premium to intrinsic value. That means, based on our assumptions about future cash generation, the current price is elevated relative to what the fundamentals support. Wall Street analysts have a consensus mean price target of $99, with targets ranging from $84 at the low end to $110 at the high end. That consensus target implies downside of approximately 9% from current levels. Taking both signals together, a reasonable fair value range in our view sits between $84 and $99. Neutral market sentiment currently surrounds the name. Insufficient recent news has moved the needle meaningfully in either direction. The next earnings announcement is scheduled for May 28, 2026, with consensus expectations for earnings per share of $2.23. That report will be a near-term catalyst to watch. Based on the valuation picture, we see limited margin of safety at current prices. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point health checklist designed by accounting professor Joseph Piotroski to screen for quality. The score runs from 0 to 9, with higher numbers indicating stronger financial health. The Toronto Dominion Bank scores 6 out of 9, which places it in the middle of the spectrum. That suggests the balance sheet has some solid characteristics, but also some red flags worth investigating. The Altman Z score is a bankruptcy risk model that synthesizes profitability, liquidity, leverage, and solvency into a single number. A Z-score above 3 typically indicates low bankruptcy risk. Between 1.8 and 3 indicates a gray zone, and below 1.8 signals financial stress. TD's Altman Z score is 0.00, which is highly distressed and unusual for a major bank. This warrants careful interpretation. Banking institutions are structurally different from manufacturing companies for which the Z-score was originally designed, and the formula may not apply perfectly. However, the result is a red flag and suggests the conventional balance sheet metrics are strained. On the debt side, the cash-to-debt ratio is 0.25, meaning the company has only 25 cents of cash for every dollar of debt. That is a tight position. The debt-to-equity ratio is 3.79 times, indicating the company carries nearly $4 of debt for every dollar of shareholder equity. For a bank, that leverage level is not unusual. Banks operate on thin equity cushions by design, but it does mean the business is sensitive to credit losses and interest rate shocks. Interest coverage, the ability to service debt from operating earnings, is not available in the traditional sense for a bank, as interest is part of the core operating revenue stream rather than an expense that stands alone. The current ratio, measuring short-term liquidity, is also unavailable. In summary, the financial foundation presents a mixed picture: moderate profitability and capital adequacy scores, but leverage levels and liquidity metrics that merit caution. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is unavailable, which limits our ability to assess how efficiently management deploys shareholder capital and retained earnings. That is a notable gap for a valuation analysis. Gross margin and operating margin are both 0%, which reflects the reality that banking does not compute margin in the traditional manufacturing sense. Interest income minus interest expense yields net interest margin, which we do not have isolated here. What we do have is the net profit margin, the percentage of every revenue dollar that flows through to the bottom line as net income. TD's net margin is 34.65%. That is healthy and reflects the company's ability to convert top-line revenue into earnings after all expenses, including loan loss provisions, compensation, and taxes. The free cash flow margin, which measures the cash the business generates after capital expenditures relative to revenue, is negative 14.57%. That is a serious concern and indicates the business is not generating positive free cash flow relative to its revenue base. This is partly a function of banking accounting and capital requirements. Banks must maintain loan loss reserves and capital buffers, but a negative free cash flow margin nevertheless signals cash constraints. Return on equity, or ROE, is 17.46%. That is respectable and shows the company is generating returns on shareholder capital. Return on assets, or ROA, is 1.05%, which is modest. In summary, the profitability picture is split: a strong net margin and decent ROE offset by negative free cash flow and zero return on invested capital data. The latest earnings results, reported approximately 50 weeks ago, showed earnings per share of $1.97, beating the consensus estimate of $1.79, a meaningful beat. Revenue came in at $16.5 billion, which fell short of the estimate. Revenue growth year-over-year was 3.8%, and net income totaled $4.04 billion. That combination of an earnings beat and a revenue miss suggests earnings management through cost control rather than organic growth. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is 10.2%, which breaks down to roughly 3 to 4% annually on average. Over the trailing 5 years, revenue growth is 9.1%, implying a slight deceleration in the more recent periods. This is consistent with a mature banking franchise in developed markets, where low single-digit growth is the structural norm. Loan portfolio growth, deposit growth, and fee income growth are all constrained by the size of the addressable market and competitive dynamics. Book value growth, the increase in shareholder equity per share, is 7.7% over 3 years. That is below revenue growth, which could indicate capital is being returned to shareholders through dividends rather than reinvested at attractive returns. The dividend yield is 2.88%, which is in line with major North American banks and offers some return to income-focused investors. The earnings per share estimate for the next quarter, when earnings are reported in May of 2026, carries a consensus expectation of $2.23 per share, with estimates ranging from 2.16 to 2.38. That implies expected earnings growth in the low single digits, consistent with the historical revenue growth trajectory. The overall growth picture is one of deceleration and maturity. The business is not shrinking, but it is not expanding at a rate that would justify significant valuation expansion. This is typical for a large, established bank, but it does raise the hurdle rate for valuation. If growth is low single digits, investors should demand a lower valuation multiple to compensate for the limited upside. Now let's talk smart money, what institutional capital is actually doing with this name. 4 top-tier gurus currently hold the DominionBank in their portfolios. That represents modest but non-zero conviction among the world's best-known long-term investors. When we look at 13F filings, the quarterly disclosures that hedge funds and asset managers are required to file showing their equity positions, 4.3% of institutional filers are net buyers, meaning they increased their positions. That is a very low percentage. For context, a healthy stock typically sees 10 to 15% of institutional filers adding to positions. Anything below 5% signals institutional caution or even subtle selling. The fact that only 4.3% of institutions are buyers suggests smart money is either holding steady or trimming exposure. Insider ownership stands at 0.0%, which is striking. That means the DominionBank's management team owns virtually none of the company. When executives have no personal capital at risk alongside shareholders, it raises questions about their incentive alignment. Over the past 3 months, there have been 0 insider buys and 0 insider sells. No meaningful insider transactions. That is a neutral signal, but combined with 0 insider ownership, it paints a picture of management with limited personal stake in the outcome. Contrast this with founders or executives who own meaningful stakes. They tend to be laser-focused on long-term value creation because their own net worth is on the line. The smart money picture at the DominionBank is decidedly cool. 4 Guru holders is not insignificant, but the low institutional buying flow and 0 insider ownership suggest that the big money is not rushing to accumulate this name. The StockTok smart money score of 2 out of 20 reflects this disconnect between consensus analyst opinion, which tilts bullish, and what large institutional investors are actually doing with their capital. And finally, the verdict. Let's bring it all together. On valuation, the DominionBank trades at a premium to our discounted cash flow estimate and offers a relatively wide range of analyst price targets with limited upside from current levels. The case for valuation is not compelling. On financial strength, the balance sheet carries elevated leverage and strained liquidity metrics, while a Piotroski score of 6 suggests some quality. The Altman Z score is distressed and warrants caution. On profitability, the company posts a strong 35% net margin and a 17% return on equity, but free cash flow is negative and return on invested capital is unavailable. The picture is mixed. On growth, revenue expansion is in the low single digits and decelerating. Growth does not justify a premium valuation multiple, which is typical for mature banking franchises. On smart money, Guru ownership is present but not aggressive. Institutional buying flow is minimal at 4.3%, and insider ownership is 0. Conviction is lukewarm. In our view, a fair value range for the DominionBank sits between $84 and $99, representing downside of approximately 9 to 22% from current levels. The latest earnings beat on the bottom line but missed on revenue, suggesting cost management rather than organic growth momentum. Taken together, the setup presents a mature financial institution trading near fair value with limited catalysts for significant multiple expansion. The dividend yield provides some income cushion, but the valuation, financial constraints, and muted growth trajectory do not present a compelling entry point in our estimation. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on the DominionBank. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.